Imagine a developer launches a peer-to-peer lending app with a perfect interface. It matches people who have savings directly with people who need to borrow. On paper, it works. In reality, the platform attracts zero users. Simple marketplaces work for coffee or clothes because the exchange happens instantly. Lending is different. It is a trade of cash today for a promise of repayment years from now, a transaction that relies on trust, accurate data, and a way to ensure the borrower follows through. This gap is where financial intermediaries operate. Banks and credit unions are specialized institutions designed to sit between savers and borrowers, handling the logistical and informational hurdles that prevent direct lending. These institutions have historically acted as a point of third-party verification, providing a structured environment where financial commitments are documented and secured. By moving money through an intermediary, savers are not just depositing cash, they are accessing a system designed to manufacture the trust required for the transaction to take place. This framework illustrates the mechanics of intermediation. First, institutions pool savings, taking small deposits from thousands of individuals to fund large-scale loans. Second, they provide safekeeping and payment services, ensuring money moves securely through the economy. They also provide liquidity, giving depositors instant access to cash when they need it, and diversify risk by spreading those pooled funds across a wide variety of different loan types. The fifth role involves the active collection of information. Because borrowers typically have a better understanding of their own financial situation than lenders do, intermediaries spend significant resources screening and monitoring every applicant. This intake of data allows intermediaries to evaluate risks that would otherwise be hidden, creating a baseline of transparency for the lending market. Markets struggle when one side of a deal has better information than the other. This imbalance is known as asymmetric information, and it creates specific risks at every stage of a transaction. The first problem occurs before any money changes hands. It is called adverse selection, a situation where a lack of information leads a lender to attract the wrong type of borrower. Economists often use a used car lot as an example. A buyer looking at cars cannot tell a high-quality vehicle from a lemon. To protect themselves from overpaying for a bad car, the buyer offers an average price. As this diagram shows, that average price causes the market to fail. Owners of good cars leave because the offer is too low, while owners of bad cars stay. Eventually, the only cars left on the lot are the ones the buyer was trying to avoid in the first place. In finance, if a bank charges a high average interest rate because it cannot identify safe borrowers, the safe borrowers will look for funding elsewhere. The pool of applicants becomes dominated by risky borrowers who are more likely to default. Intermediaries combat this by using screening tools. They require public financial disclosures, check credit histories, and demand collateral, valuable assets the lender can claim if the loan isn't repaid. Institutional screening turns hidden risks into observable data, ensuring that capital moves toward viable projects rather than defaulting loans. The information problem does not end once the loan is approved. As soon as the funds are transferred, the relationship enters a new phase. This post-funding risk is called moral hazard. It refers to the change in behavior that occurs when an individual is using someone else's capital. In equity financing, where investors own shares, this appears as the principal agent problem. Managers might be tempted to use shareholder money to expand their personal influence rather than maximizing the value of the firm for the owners. In debt financing, the borrower may take higher risks with a loan than the bank intended. If a risky project succeeds, the borrower keeps most of the profit. If it fails, the lender loses the principal of the loan. To manage this behavior, intermediaries use restrictive covenants, legal rules that limit what a borrower can do with the funds. They also conduct ongoing monitoring and may require specific insurance to protect the value of the collateral. These institutional safeguards ensure that the borrower's incentives remain aligned with the lender's expectations throughout the entire life of the agreement. Returning to our original app, we can see that a successful financial system requires more than just a digital match. It requires a way to overcome the information gaps that naturally exist between strangers. By solving for adverse selection and moral hazard, intermediaries reduce the risks and costs of moving money through the economy. A growing economy relies on these institutions to build the pipelines that allow capital to flow safely into productive investments, businesses, and infrastructure. This video was produced by the David Eccles School of Business for educational purposes only.